What's up, everybody? Jimmy Jackson, licensed realtor, Keller Williams, GR North, Team Takens. So I'm making a quick video again. My last one, my service got all messed up, man. They're doing a little fixing up with the internet again at my studio, or at my office. So I'm just at home, hoping that this connection, I got my Ethernet connection connected directly to the internet. So this better be working a lot better. Anyways, so let me jump into it real quick. So today, what I'm going to be discussing is obviously the fixed rate, the adjustable rate mortgages versus the fixed rate mortgages. So, you always want to ask yourself, should you lock in with a fixed rate mortgage, or should you take the advantage of a lower adjustable rate mortgage? One gives you certainty, the other one gives you flexibility. So let's break this down simply so you can decide what actually fits in your plan, what would work better for you. These are two different mortgages that benefit two different situations. I wouldn't say two different people, I'd say two different situations. A fixed rate mortgage means that your interest rate never changes. It doesn't change next year. It doesn't change in the 10 years, to 20 years, to 30 years. Unless you do a refinance, it stays the way that you agree when you sign those documents. That's a fixed rate mortgage. Your monthly payment stays the same, the entire loan. That's why, you might be like, Grandma, why are you still paying $300? I got this home in 1965, or if she's even still paying on the property. She might have did a refinance in the 80s. So, her payment went from, 200 or from 400 to 300, but she's still paying, or who knows. So now, let's touch base on, a few things as we talk as well. Like there's also something called an interest only loan. So interest only loans are also something that I'm going to talk about just a little bit. Interest only loan are what scammed people. They are the loans that people really got stuck into in the 2008 crisis. A lot of people were stuck in those interest only loans. So I'll talk about those a little bit in a few minutes, but because it was very, very damaging. Loans were given to people who weren't qualified for it. That's why you want to make sure that you talk to someone who knows what they're doing, trustworthy, and know what you're doing, and what you're signing. You know what I'm saying? Because foreclosures went crazy. Like millions of families lost their homes, and there was entire communities that were wiped out because people were giving things that they shouldn't have done. So, and a lot of banks and institutions were sued and had to give billions of dollars. But and it wasn't just about the market; it was about the the morals. I would say about how corrupt the people, when they want to be greedy and take the money, how they could be. So modern day adjustable rate mortgages are more regulated than they were in 2008 or before 2008, I would say. So there's definitely been a lot of changes. But one second. Yeah. So the adjustable rate mortgage, like who would want what? You know what I mean? Who would want what? So if you are a person who is looking to just get a home, you're a first time home buyer, you're looking for a home, and you're like, hey, this is the home I see myself being in for the next 10, 20, 30 years. You know what I mean? And this is where I see myself staying, raising my family. And fixed rate mortgage is something that you want to, lean more towards, because a fixed rate mortgage is, when you're getting comfortable, um, when you plan on just, staying there for a longer period of time, versus the adjustable rate mortgage. The adjustable rate mortgage is a little more towards investors. They're a little more towards, you know, people who are going to do like a 3, 5, 7, or 10 year plans. So I'll touch base on that really quick as well. Um, Basically, when you're getting in, when you're doing an adjustable rate mortgage, you have options. So if you want to do an adjustable rate mortgage, a lot of times you can do rate adjustments. So there's a delayed principal reduction, because you have your principal, your interest, your taxes, and your insurance. Those are what you pay if you're getting an adjustable or a fixed rate mortgage. So the principal is adjusted. That's like the money you owe on the actual house. The I is the interest, the T is the taxes, and the other I is the insurance. So if you're getting an adjustable rate mortgage, those rates are going to be adjusted. So you want to be able to take that risk. You know what I mean? You want to be like, can I afford this? Is this something that I would want to do? And the 2008 crisis definitely taught people, you know what I mean? Like the right mortgage is the one that you can afford today. Not the one that sounds good for tomorrow, because don't make assumptions without knowing what you plan on too soon. So if something's adjustable, it sounds good, but get something that you're fixed and flat and ready to go for today, for a long-term home loaner. I mean, for a long-term home owner. You know what I mean? Because those rates are not predictable. You know what I mean? So like if they're low right now, that doesn't mean they're going to stay low when you're doing an adjustable rate mortgage. So like let's say you take out a loan for 200,000 on a 30-year fixed rate mortgage at 6.5%. Your principal and your interest is about, let me look at it, 1,264 per month. That number is never going to change. That's on the fixed rate. Now, if the economy changes, if the economy crashes, it doesn't matter. That's your payment. So once again, families who plan on staying there or who values their budget stability and doesn't like to take risks, that would be your better chance, would be the fixed rate mortgage. So because even if the rates go up, anything, you're good. Now let's hit a little more on the adjustable rate mortgages. Let's touch base on when the interest rates fluctuate, what catches people's mind, what gets people stuck into these who shouldn't be. Let's say you have it set up with the lender that you want to do an adjustable rate period for 3 years or 5 years, 7 years, 10 years. Those are usually like the base set time periods. And you're doing good right now, but you get it at like a 6%, and you're like, oh well, I see we have a new president or something like that. I'm pretty sure that the interest rates will probably drop down. I just have that gut feeling. Or you're like, I just got a new job. I'm pretty sure I'll be making more money by then. So let me lock it in. Okay. You're thinking, why would you make that assumption? Well, just like the market, the rates are always going to fluctuate. But here's the thing. Usually it's lower payments up front. So unless you have more flexibility and you can change more risks, that is going to change, after your 3, 5, 7, or 10 years are up. So they start you off with lower payments. So it sounds good. It's like, oh, damn, I'm only paying $200. Okay, cool. But once that 3, 5, 7, and 10-year plan ends, those adjustable rates are going to change on you. It's just according to what the market is at. So here's an example. Let's use that same $200,000 loan at a 5/1 adjustable rate mortgage at 5% and start with payments. It would start with payments around $1,073 per month for the first 5 years. Okay. That's nearly $200 less compared to the fixed rate mortgage. All right. So you're like, damn, this is nice. You know what I'm saying? I'm getting a better deal. Sounds good. It's a 5-to-1 fixed rate. You're like $200 less. Cool. But here's the catch. After 5 years, that rate can go up or down depending on the market conditions. And if the rate rises, your payments rise also. So the best people who should get those are people who plan on selling in a few years, like an investor, a homeowner who plans to refinance, or you know for a fact your income is going to increase, people who understand and who can manage financial risk and literacy, or it's, if you just don't plan on staying long, that'd probably be a good risk for you if you don't plan on staying long. So, sorry, 1 second. I'm scrolling down something really quick. Yeah. So yeah, that's pretty much this video. It just got dark outside really quick during this video. Talk about getting dark quick. I'm trying to slide up. Man, it just got dark quick. But anyways, and I do not have the light in here from my office. Anyways, yeah, that's that. Like I always say, if you have, man, that light is not very bright. If you have any questions, if you need any advice, if you're looking for, you just want to do a walkthrough to see the value of your property, if you're looking to get a pre-approval, see the steps and procedures on getting a property yourself, if you have any questions, don't be shy. Get a hold of me. I'd love to help you out. Thank you very much. Have a blessed evening.